So today what we are going to be learning about is revenue from contracts with customers. So have a look. So what we will be learning in this chapter is we will learn about discussing and applying the criteria model for a revenue recognition, and then what are the 5 steps models, such as like first of all you identify the contract, and then you identify the separate performance obligation, and then in third what you do is you determine the transaction price, in fourth you allocate the transaction price, and then in fifth you recognize revenue. So we will look at the 5 steps model used, and then after that we will also look at the criteria recognition model of contract assets. So when which costs are actually capitalized, which are not. So we'll look at that as well, and then we'll look at the modifications. So modifications will be also into 2 types, such as like modification to the contract, or whether it's just an existing contract kind of thing. So it could be separate, or it could be just an old one. So we'll look at that as well, and then we'll also look at the recognition and measurement criteria. So there will be performance obligations in it. So it could be divided into 2 parts, conditional and non-conditional. The performance obligation could be conditional as well, non-conditional as well, and then the other thing will be it could be satisfied over time or at the point in time. And we'll also look at the consideration. So the consideration could be like, it could be variable consideration, or the revenue, the transaction price could also include financing component, and then after that it could also include the cash-based payment. So these are the things that we'll be looking at, and then we will also look at principal agent. So how they will actually account for their revenue, such as like suppose the principal is the airline company, and then the agent is just a ticketing company. So how they will recognize the revenue, we'll look at that. So yeah, let's move into what is revenue. So revenue is anything with a principal for operations. So it's a income generated from core principal operations or in a normal trading. So that is our definition of revenue. So early on, revenue was quite criticized, like because it wasn't very clear, so they had to revise this IFRS. So that's why they came up with this new IFRS 15, and then it replaces the contract cost as well. And then before it was IAS 18 or so, revenue. So they have replaced that. And then let's look at 5 steps model. 5 steps model. So in this, the first thing what we have is identify the contract. Identify the contract. So what would be a contract? It could be it doesn't have to be a return contract. It could be a verbal one as well. But what we have to determine is that the contract must include few of the details, such as when the revenue will be received, when money will be or revenue will be received, timing and date of receivable, like when it will be received. So it could be timing, you could say timing as well. So you could identify parties, how many parties are included in it. So in the 5-step process, the first step is identifying the contract. So what is a contract? It's an agreement between 2 parties, and it's a right for one party and obligation for the other. So if you look at it as well over here, it's an agreement between 2 parties, and it creates rights and obligations. So it's a right for one party. Suppose this is entity A and B. It's a right for A. It's an obligation for. If it's a right for A, it's an obligation for B. And if it's a right for A, if it's a right for B, There is obligation for A. Then after that, what are the criteria? So what is a contract, and then what's the criteria of a contract is the parties have agreed to approve the contract, and each party's rights and obligations can be identified. The next thing is payment terms can be identified. So if the payment terms are not clear, then it's not an agreement. We need to have the payment terms as well. And then the contract has commercial substance. Remember, always substance over form. So it's always should be of substance. And then it is probable that the entity will be paid. So suppose there is a contract, and then after that, what's the provision of the contract is that suppose A is given a task to construct a building, and the cost of the building is suppose 2 million. Whereas if the security amount that the B has provided to A is only 100,000, and his only right is still this 100,000, then that cannot be considered as a we cannot recognize the revenue in this case, because it is unlikely that the company will be paid. So see, that's the important definition, probably that the entity will be paid. So it should be probable as well, and then it should be mentioned in the contract that the cost incurred will be recovered, or the entity which is constructing the building has a right. So let's look at number 2, process. So let's identify. So we have identified the contract. So let's identify what's the performance obligation within the contract. So the second step in this 5-step model is to identify the separate performance obligation within the contract. So what could be a separate performance obligation? Suppose like when you buy a bike, so there is a contract with them that they will provide us the free servicing. So that's a separate performance obligation from their perspective, right? So we have to, it's included within the transaction price, so we need to allocate it to the separate performance obligation, which is a distinct goods or services. In the bike case, it is the servicing, which is a distinct service. So let's look at what is a performance obligation. So performance obligation is a promise to transfer distinct goods and services to the customer. So we transfer, or the company or whoever is selling the good has an obligation or has made a promise to transfer distinct goods and services. And then after that, so how do we determine the distinct goods and services? So when we are allocating the price to a distinct goods and services for that servicing, suppose the servicing is 300 or 400, like during the normal course of business, so we have to allocate 300 or 400 into 4 times, or how many servicing we are giving. So we have to actually account for it as well. So that's not recognized in the revenue right now itself, but as it is performed, it is recognized over time, or whenever the performance obligation is satisfied. So that's the main gist of it. So if sold separately, then it forms a distinct obligations. So suppose if the service is, they sell the servicing as well as a separate part, right? So that is a distinct obligation for the company. And then in this performance obligation, there is a principal and agent concept as well, which is that we have to define the nature of the obligation. So whether it is the principal or it is the agent kind of thing. So who is a principal? Is the person who provides the goods or services itself. So suppose an airline company. So they provide the flying services to the customer itself. So they are the principal agent, right? Principal. So who is the agent in this context? It is the ticket booking companies. They are the agent. So a principal is anyone who provides goods or services itself. That's principal. And then anybody who recruits somebody else to provide the service or goods to another party, it is agent. Okay, so and another criteria that you can look at is as well when determining it's a principal or agent is that they control before the goods or services are transferred to the customer, so they have a control over it. And then whereas this agent, they are the one through which it passes, right? So they are the ones who are who have the right to revenue based upon their fees. So the cost price of the ticket is not their revenue. It's only the commission that they receive is their revenue, not the whole price of the ticket. Okay, that's very important thing. And then after that, warranties. So in case of warranties as well, what we normally do is like some of them provide warranty or some of them sell it like separately. So if it is sold separately, then it forms a distinct obligation, and then the price will be when it is sold as a standalone product. So that will be our price, and then it should be allocated to the performance obligation. So whereas in case of warranties, we use IFRS 37, provision, contingent liabilities, and contingent assets. And then after that, on this thing, we use probable, possible, remote, and then virtually certain, that criteria. And then that's how we recognize revenue. So the most important thing that you need to remember is performance obligation is a promise to transfer goods or services to a customer in a later date or like at the point in time. And then it is sold separately, then it forms a distinct obligation. And what we need to also define is the nature of obligation, whether it is the principal who has obligation or the agent. So that will be also important to actually determine which revenue to recognize. And then after that, it's the most important gist in this in understanding this performance obligations allocation is that if it is sold separately, what price will it be sold? So in case of the bike thing, so if the bike has been sold and then when a normal customer comes, and then how much do you provide the servicing for that customer? So that's the standalone selling price, which will help us determine allocating the cost of service obligation. So now what we will do is, let's look at transaction price. So how do we determine transaction price? Determining transaction price, step 3. So as per IFRS, what IFRS 15 says is that transaction price is the amount of consideration that the entity expects in exchange for satisfying a performance obligation. So it is the expectation of a transaction price or amount of consideration that the entity will expect after it satisfies a performance obligation. So that is our transaction price. And then there could be different kind of transaction prices. So it could be like variable. It could be like variable in terms like, let's say, suppose you are a construction company, and then what your employer says is that suppose you are building a building for entity B, and then if you expect to complete, like if you complete it within like anticipated time, then you will get rewarded. So there will be an incentive for the builder, which is A in this context. You will have a incentive to fulfill the contract within time. So this is a variable consideration, and then we only recognize it when like it is probable that the recognized revenue won't reverse. So there is a condition, we'll look at it again later on. We will go in depth with variable consideration. We'll do some examples as well, and then let's look at significant financing component. So significant financing component is like suppose the entity is A, or let's say it's a Bajaj. So suppose Bajaj sells you a motorbike. for, let's say, 150,000. So they say that the amount is only payable after 3 years. And 0% interest rate. So see, sometimes they give some schemes as well for the customer. So we need to look at like the amount will be received only after 3 years, right? So it includes the transaction price, includes the significant financing component itself as well. So we need to bring it to present value for the date, at the date of measurement. So this is very important. Like we need to look at like whether the transaction price has a significant financing component or not, because usually like when there is a scheme happening with cars or motorbike, when they are selling, they actually offer this kind of facilities to customer just to lure them, and then that amount includes the financing component as well. So this 150,000 includes the principal plus interest. So that's what is financing component. And then non-cash consideration. So non-cash consideration is like suppose you bought a goods and services, or like you bought a goods and services, and then like your customer bought a goods and services, and then what they actually do is they pay you by giving their shares. So it's a non-cash item. So it is measured at the fair value at the date of transaction, and then that fair value will be recognized as a revenue, and any increment on the value at the reporting date will be recognized in profit or loss, just normal gain or loss. And then when you are doing this non-cash consideration, so what happens usually is that in this case, what happens normally is that sometimes you can't determine the fair value. Suppose if the company is unquoted company, so suppose A is the entity, B is the entity. So suppose you are the A supplying goods to B, and then B purchases goods from you. So what happens is you expect some form of payment, right? So what B does is that he gives you a share, but what happens is that you don't know the fair value of shares of this B. So what do? It's an unquoted company. So you look for level 1 or level 2 or level 3 information as per IFRS 13 fair value measurement. So if you can't determine that fair value, then what you actually have to do is that if you sell this special product that you just transferred, what will be the standalone selling price? So that will be your price. Okay, so if the customer if you didn't sell to B, but you were supposed selling it to other customer, and then what would be the standalone selling price? That would be your revenue. Okay, so and then after that, let's look at this consideration payable to customers. So suppose you're a department store, and then after that, you sign a contract with the customer that they will buy, like let's say 10 million of goods or services, and then after that, they also say it's like, okay, I'll sell your product, but you have to actually decorate this space for me, and then you have to pay me for that. So on that case, what we normally do is that it is a consideration that we have to pay to the customer as well, right? So what the supplier does is that he or she reduces the amount from the transaction price itself. So based on the proportion of the goods bought, or like based upon the agreement. Suppose the customer bought 10 million of goods, and then after the contract was 10 million, and then they only bought 2 million. So, and then the expenses was, let's say, 3 million. So this expenses would only be deducted from transaction price as per the proportion of these two things. Okay, so how much he sells, that percentage out of the contract amount, that will be deducted from the transaction price. We'll look at some problems as well, so it'll be much more clear for you. And then yes, let's look at variable consideration then. So let's not forget the definition of transaction price. Transaction price is the amount of consideration that an entity expects to return for satisfying a performance obligation. So this is very important definition. Transaction price is amount of consideration that an entity expects to receive after satisfying a performance obligation. And then performance obligation could be anything. Like we said in the step 2, we identify the performance obligation. In the first, we identify the contract, and then after that we determine the transaction price. So the next will be allocating the price for performance obligation. But first of all, we need to look at this four consideration, which could be like variable consideration, significantly corporate, and then non-cash consideration payable to customer. So let's talk about it in more detail. Variable consideration. So the first is variable consideration. And then what is variable consideration? So variable consideration is the estimate can only be included in transaction price if it is probable. So included in transaction price if it is probable that a significant reversal in amount of cumulative revenue recognized will not occur when the uncertainty is resolved. So what this actually means is that so the main idea behind this is that suppose you recognize the revenue, and then suppose the transaction price was 10,000 and then the revenue was 8,000, and then you want, if you recognize this also 2,000 as a revenue as well. So what happens is that if later on this figure has to be reversed, then after that it will be a problem, right, for the entity, because again that will have already impact on your profit or something, and then after that you would have already distributed your dividends. That could definitely impact it. But so to solve this problem, what this paragraph 56 says is that variable consideration is only included in transaction price if it is probable that a significant reversal in amount of cumulative revenue will not occur. So suppose if you have to reverse this 2,000 back again, not as a revenue, then that will be a problem, right? So in the beginning, when you're recognizing revenue itself, you need to be careful that the revenue that you're recognizing, the 2,000 that you're recognizing, is probable that it won't be reversed later on in a later date or when the uncertainty is resolved. So that's a very important factor that you need to consider when recognizing a revenue. So let's do a problem of this, and it should be very clear for you. From the book itself of SBR, let's look at TYU1, Bristow. So TYU1, Bristow. So Bristow, what the question actually says is that on 1st December 20x1, Bristow produces a service to a customer for the next 12 months. The consideration is 12 million. Bristow is entitled to extra 3 million if after 12 months the number of mistakes made falls below the threshold. So discuss the accounting treatment for the above in Bristow's financial statements for the year ended 31st December 20x1. If a number is, Bristow has the experience of providing identical service, and it is probable that the number of mistakes will fall within the threshold. So the next condition is Bristow has no experience in providing the service, so it is unsure about if the mistakes will fall within the expected threshold. So the important thing over here is that what is the experience of the company. So what that supplier or the guy who is providing the goods or services is saying is that if you complete a certain things without making a mistake, you will be rewarded, and then if you don't do it, you won't get that amount. So what we have to do as a entity who is actually selling that, who is actually getting that amount, is we have to recognize which amount should be recognized in the revenue. So the transaction price would be, in case of A, when determining the transaction price, what we have to look at is the consideration is provides a service to a customer for next 12 months. So it's an overtime service. And then our year ending is 1st 12/20x1. I mean 31st. So we are at the same month. 20x1. So we have to account for this date, and then the service will be provided from this date to the next 12 months. So since our year end is only 1 month, so we have to account for only 1 month. So what we have to do is that Restore Receive provides a service to the customer. The consideration is 12 million. Debit cash. Revenue. And then after that, the amount that you are receiving is for 1 month into the revenue that you are receiving is 15 million. So your revenue for the first month is this much, and then the other is your liability, because you still haven't rendered the particular person the service that he demands or that he has paid you for. So performance obligation is only recognized as it is satisfied, right? So let's look at this. 12 divided by 15 divided by 12, 1.25. And then after that, so this won't be this amount, it will be the full 15 million years, because the amount that you're receiving is 15 million, right? So 15 minus 12.5, so 2.5. 15 minus 1.25, so 13.5 million contract liability, or so the question has only asked you which is the revenue that you need to recognize. So we will recognize 1.25 million as the revenue. Okay, so I'm just giving you the example. So we don't have it very clear in the question that we have actually received the cash or not, but I'm assuming that we received the cash at the beginning. So I have done debt cash, and then after that credit revenue. So that is only our revenue that has been recognized. So 1.25 is the amount of revenue that we recognize for the year ending 31st/12/20x1. So what would be in B? The company has no experience in providing the service. So what we do with the revenue is we can only recognize 1 out of 12 because we have only provided 1 month of service. And then what would be our multiplication factor is not 15 right now, because it has no experience in providing that service. So it is probable that the reversal might occur. So we don't recognize it in revenue right now. Okay. So what we have to do is 12 divided by 12. And then the revenue would be 1 million. So see the difference. So if you are actually recognizing that amount of revenue which would be reversed at the end of the period, or when the uncertainty is resolved, then you would have recognized higher amount, and then you would have to again reverse it. Whereas if you actually don't recognize it in the beginning itself, then you won't have to reverse it at the end. So that's the main gist of this problem. So how much revenue you should recognize, that's the gist. So suppose this Bajaj is selling this particular motorbike for 150,000. So what you would do is, suppose you are receiving the payment after 1 year. So how much revenue should you recognize? So you are receiving 150,000 into, suppose, let's say the discount rate is 10%. So it will be 1 divided by 1.1 to the power 1, because you are receiving it after 1 year. So debit would be receivable You still haven't received the money yet. So the present value for this would be 150,000 divided by 1.1. 136, 1,36,363. 100,000, 136, 363. So this should be a receivable. And then every year you will account it as per IFRS 9. So first of all, in the initial measurement, you would recognize this amount as the revenue, and then after that, you would actually account it for using IFRS, because now this is a financial asset. So what you have to do is it falls under this IFRS 9 financial instrument. In terms of financial instrument, we have already discussed about the debt instrument. So we will look at other kind of financial instrument as well, like this sort of financial instrument as well, financial asset. And then we'll look at how to account for it, and you will have more detailed knowledge of it, because there will be some impairment as well, and then we have to acknowledge some impairment loss, and then that would be if there is a significant deterioration in the amount that you would have to recognize, then you would have to take the lifetime of the thing, of the difference between, you would have to expect that it is for the next 12 months or for the lifetime, so you have to look at it. So we'll look at it as well. And then the other thing that you have to be careful in this thing is non-cash consideration. So non-cash consideration. So in non-cash consideration is that suppose you sell, suppose this Bajaj sells motorbike for, let's say, 150,000. And then suppose that person is giving you shares. What you have to do is that, suppose this particular fellow is giving you 100 shares or 1,000 shares at the rate 150. So you have to recognize 150,000 as the revenue. So this is the initial recognition, and then the subsequent recognition. So there might be changes in the fair value of the shares, right? So suppose if the shares the value of the share has reduced by, let's say, 10 at the year end, so you would have to book a loss. PL, so 10,000 would be a loss because the value has been reduced by 10,000. So, or if it were like increase, so you would have to recognize again. So this is how you actually account for non-cash consideration. And then let's look at consideration payable to customer. Oh yes, and then the important thing is that, like, this is a quoted company, so that's why you are able to get the price of this. Okay, so if it were a quoted company, then what you have to do is you will have to determine it by the standalone selling price. Standalone selling price. So if the value of these shares can be determined properly, or let's say, like, because it isn't traded in the active market, so you can't determine the value. So how will you do it? So you can't measure it reliably, right? So what you would do is you would take the standalone selling price of that particular goods or services if you were to sell it to another customer. So you would use that amount to recognize the revenue and whatever loss or gains that might happen. So you would actually account for it that way. And then let's look at consideration payable to customer. when a consideration is payable to a customer, there would be two situations. Okay, so suppose if it is consideration paid in exchange for distinct goods or services, then it should be accounted for as a separate performance. I mean, separate purchase transaction. Okay, and then after that, if the consideration is not in exchange for distinct goods or services, then it should be accounted as for reduction in transaction price. So, if you would look at like QIU5 or Golden Gate in your book as well, so what you would see is that so the customer has signed a contract to actually purchase 20 million of goods, and then what the company supplier has to do is that he has to pay he has to pay 1 million for not for the distinct goods or services, but for that customer to purchase that particular goods or services. So suppose if that guy has to do some decorations or something, let's see in the book as well, might have mentioned. Okay, so it says over here, so 1 million to compensate for the changes that he has to make in the store. So that's same as our example of department store. So the guy has to spend, the entity has to spend 1 million in redecorating the particular side of this department store. So that would cost 1 million, and then he or she, the entity has promised to purchase 20 million of goods. So he has already done an agreement. So till now, what he has done is that he has already purchased 4 million of goods from us. So what we have to do is that how much would the transaction price be reduced by? 5%, right? Total, because he would only be giving us 19 million. So that would be a reduction of 5%. So you could also get the proportion by 1 divided by 20. And then how much revenue would he recognize at 31st December 20x1? As he has only purchased 4 million of our goods, so what we do is we reduce the 5% of 4 million because that's his cost. He has that's his cost right now. So we have apportionate it based upon the goods that he has actually purchased. I mean, like the goods he has purchased 4 million. So we have to reduce the proportion of expenses that would be incurred or that would be payable by us. So we would get a revenue of 3.8 million would only be recognized. So we have to reduce 4 million minus 5%. Okay. So I hope it is clear, guys. And then after that, what we will look is step 4. What we will do is allocate the transaction price to performance obligations. Let's do that. Step 4. Allocate transaction price to performance obligation. So how do we actually allocate transaction price to different performance obligation that we have? When allocating transaction price to performance obligation, what you have to be careful about is that the transaction price should be allocated to all performance obligation in proportion to their selling price. So based upon the standalone selling price, you would actually allocate the performance obligation based upon the proportion of selling price. Okay, so transaction price needs to be allocated based upon the based upon the performance obligation in proportion to selling price. So suppose you offer a discount to a customer. So what you would do is that you would actually proportionate the discount amount by their selling price. Okay, that's very important thing. And then after that, the best evidence of standalone selling price is the observable price when the goods and services is sold separately. Okay, so suppose if the customer is to be provided with the technical support of, let's say, maintenance or something. So what you would have to do is that, suppose when you're selling the separate, when you're selling that technical service separately, so how much price would you charge? So you would have to take that into account and then allocate it based upon that. And then after that, standalone selling prices, if it's not directly observable, what you would have to do is you would have to use estimation, or you would have to estimate it. And then what would be the estimation? In estimation, you would actually have to use observable inputs, okay, so such as market interest rate or anything else. And then after that, so that would be very important. So to determine standalone selling price, if it can't be determined, it needs to be estimated. And while estimating, you should actually try to use observable estimation or observable inputs for your estimation. And then let's look at TYU6 thread, where we will actually look at this transaction price allocation in context of performance obligation in proportion to their selling price. So let's look at it. So what we have in this TYU6 is that TYU6 shred, what we have is, let's look at the question. So Shred sells a machine and 1 year free technical service for 100,000. So what that person actually does is that sells for transaction prices 100,000 for machine and 1 year service. And then after that, the sale of the machine and the provision of technical support has been identified as separate performance obligations. So these are two separate performance obligations. And then Shred usually sells the machine for 95,000. And then, but it has not yet started selling technical service for this machine as a standalone selling price, okay, standalone product. So it has not yet started selling technical support for this machine as a standalone selling price. So he used to sell the machine, but he hasn't actually sold the 1 year service as a separate product. So what we will have to do is that in this case he has actually sold it. So let's look at it. Other support services provided by Shred contract a markup of 50,000. It is expected that the technical support will cost Shred 20,000. So it would cost him 20,000. So it's a markup of 50%. So what you would do is 150%. So it's a markup, not on margin, but it's a markup. Okay. So 30,000, right? So in this case, what has actually happened is that goods worth 95,000 and then 95,000 plus 30,000, 125,000 has been sold for this amount, 100,000. So what we will have to do is that we will have to actually allocate it based upon their selling price, right? So the selling price is 125,000. So what we will have to do is the amount of discount that he has given is 25,000, right? And the selling price is 100,000, and then the amount of discount that he has given is 25,000, right? Yep. And then after that, what we have to do is as per the proportion. So what we will do is 95 divided by 125, or 95,000 divided by 125,000, 0.76. So what would be 0.76 of 25,000? 19,000. And then what would be the rest? 19 minus that would be 6,000. So how did we get this figure? Is what we did was 95,000 divided by 125,000 into 25,000. So we allocated it based upon the selling price, standalone selling price. For each, so these are two separate performance obligations. So as we talked earlier in the definitions as well, and then what we said over there was we have to allocate the transaction price for each performance obligation. So how would we do that? The total selling price is 125,000, and then the proportion of 95,000 goods, which is the machine, is 76%. So this is 76%. The rest is 24. So the rest is 24%, right? So while allocating the discount as well, we would actually give the discount in same proportion as their selling price. So or what we would say is that we would allocate it based upon their proportion of selling price. And then what you would actually get over here is 76,000. So while recognizing revenue, what we have to be careful about is, like, we recognize revenue only when the performance obligation is satisfied, right? So during the performance obligation being satisfied, so it could be two cases that might come, which is at the point in time. So it could be like, suppose you were supposed to deliver a bike or service. So you delivered it, and then the customer has the control, and then that is at point in time. Whereas in other cases, so the servicing part is like it's over time, right? It is satisfied after a period of time, because the customer has to take the bike and then run it for few thousands of kilometers, then only he'll get a service. So that is considered overtime. So there is a time thing in that. So always we need to be careful about is whether it is point in time or overtime. And then overtime criteria. So if it meets any of these, then it is considered as overtime. Okay. So the first criteria is customer simultaneously receives and consumes the benefits. So suppose when you're having a haircut, so it is overtime, but you actually receive the service and then you're consuming it as well. So that's the first case example. And then the second case is entity's performance creates or enhances an assets that customer controls. So in this case, it's like, suppose you're building a particular building or specialized factory for some of your customers. So in that case, the customer has the control of the building. So you don't have the control, but the customer has the control already. So you are enhancing an asset that the customer already controls. And then the next criteria is entity's performance does not create an asset with an alternative use. So this is very important. Alternative use to the entity, and the entity has enforceable right to the payment to performance. So what this actually means is that suppose you are a car making entity, and then what you normally do is you sell the cars. But if a customer comes with a special request and then you create a special car for that person, then that's a alternative, like that's a new car, and then you can't sell it to anybody else because they might not want it, because it's a specially designed car for a particular customer. So it doesn't have an alternative use, and then the firm can't sell it and then generate revenue out of it. So it should have an alternative use as well. This is also very important criteria. And then what we actually have to assess is that when they are actually giving a special order, then we should also have an enforceable right to the payment for our performance when we are providing the service.
Okay, so what we will do is we will quickly look at some few problems, and then this will be very clear to you. But in this C criteria as well, there should be two conditions. It should not have any alternative use, and then there should be enforceable right to payment. Even though if it doesn't have alternative use, but we don't have the enforceable right to payment, then it is not satisfied over time. Okay, so we have a case about that. So we look at it, and then point in time is when the customer obtains the control. And then the other thing that's important in this thing is measurement. So measurement is done by two ways. First is input method. Second is output method. So output method is primarily determined by surveyors, like outside surveyors. So they come and do the surveys, and then they assess how much work is completed. So based upon that, we recognize revenue. Whereas in case of input methods, what we do is we recognize revenue as the cost is incurred. So which is always in proportion to total estimated cost. We'll have a look at problem, and it should be pretty clear. So let's have a look at a few problems. In this particular TYU, we are looking at events, right? So the question has asked us that what would be the accounting treatment on 30th of June 20x1. So what has happened in this question is that on 20x1, the 1st of January, the company has entered into a contract to provide monthly payroll services. Okay. So this particular entity has entered into a contract to provide payroll services for 120,000. So this is a single performance obligation. So you don't have to supply any other goods or anything. So this is supplying payroll services is a single performance obligation. Single performance obligation, and then after that, so the customer, what they normally do is, like in this particular case, is that we would if this is a overtime or not, we would have to assess three criteria, as I have already told you. The first criteria being that the customer must consume the product simultaneously as they are receiving it, like haircut. As in this case, it's similar. So they consume it as they are receiving the service. And then the second criteria is that the entity enhances the asset that the customer controls. So like you're building a specialized factory or something else, and then so you are actually building an asset for the entity that they control themselves. So that's second criteria. So it doesn't fall on that. So in the third criteria, what we had was it does not enhances the asset, but it does not have a alternative use either, and there is a entitlement to the money. Okay, so those are the three criteria. So this falls under the first criteria. So this is revenue recognized over time. So as the performance obligation is satisfied, we will recognize revenue. So the question has asked what would be the accounting treatment until 30/6/20x1. So what we would do is we would recognize revenue of 120,000 into service provided. So it's 6, and then we entered into a contract on the first, so it's 6 months that we provide services for the 6 months to go. Total number of months is 12, so we have provided 6 months of service, so our revenue is 60,000. Why? Because we have provided 6 months of service. Okay, so in this particular case, the customer simultaneously receives and consumes the service. Okay, so now let's look at TYU 8.
This is a very interesting question. GYU8. It's about Crawford. And in this particular question, GYU8, Crawford. So I'll read out the question for you. On 31st March 20x1. So 31st March 20x1. 31st March 20x1. Right? So what happened on this day? Crawford enters into a contract to construct specialized factory. Contract. Specialized factory. Specialized. Factory for a customer. The customer paid an upfront deposit which is only refundable if Crawford fails to complete the construction within in line with the contract. So he has to complete it within the specified time. So upfront payment. So upfront payment has been made, and then the remainder of the price is payable when the customer takes possession of the factory. So remaining is paid at the end of the period when the customer actually takes the control of the factory. And then if the customer defaults on contract before completion of factory, Crawford has only the right to retain the deposit. So this is the deposit amount. So what we had already told is that, so should Crawford recognize revenue for the above transaction over time or at point in time? So over time or at point in time? So in this case, we had a criteria in over time. The third number bullet was entity performance does not create an asset with alternative use to the entity. And enforceable. Right to payment for performance completed to date. So in this case, so Crawford has entered into a contract, and then the specialized factory is being built, and then the customer has already paid an upfront payment, which is also a deposit, which is only payable if the Crawford does not complete the specialized factory. So is it revenue recognized over time or at point in time? So in order to assess this, we know that the third bullet of overtime criteria is that it does not create an asset with alternative use and enforceable right to perform completed enforceable right for the performance completed to date. So enforceable right to payment. So this is payment as well. So as you when you look at the question, it says that it's a specialized factory, right? So specialized factory, it does not have a alternative use as well. And then even though if it did not have that, what has happened is over here, the enforceable right to payment is only the deposit amount, not the performance or not the performance obligation that has been satisfied. So you are only being paid the deposit amount. So you only have right until the deposit amount. So it is not overtime. Why? Because even though if it had satisfied this criteria, the assets with alternative use, even though if it does not create assets with alternative use, but this does not have alternative use either, remember? And then the enforceable right is only up to the deposit amount. So let's say if the construction was costing you 12 million, 12 lakh, and then after that your deposit amount was only 500,000. So your enforceable right is only up to 500,000. So you are not receiving the other cost, even though if you don't complete it. So you don't have the enforceable right, so it is not considered as overtime. It is considered as at point in time. In the question also, it clearly says that at point in time. It says that the customer will pay only after he or she takes the possession of the factory. So at that time only they actually make the payment. So it is considered, it is recognized at the point in time, not overtime as it is said. So if you look at QIU9 Baker, so what you would find is that I'll read out the question for you, so it will be much more easier. On 1st of January 20x1, Baker enters into a contract to build a specialized building for 2 million, for a consideration of 2 million plus a bonus of 0.5 million if the building is completed within 18 months. So the condition is that it is a variable consideration, and then it is only likely that if it is completed within 18 months, then we would receive it. And then what the question clearly says is that estimated cost to complete is 1.5 million. And then after that, if the contract is terminated by the customer, Baker can demand for the cost incurred to date plus cost incurred to date plus 30% of markup on that amount. So it is basically 130%. So on this date, the Baker is not quite sure if it would receive the bonus or not because of factors outside its control, such as weather and regulatory approval. Okay, and then as at 31st December 20x1, Baker is still unsure whether the bonus target would be hit. So Baker decides to measure progress towards completion based on cost incurred. So this particular entity is using output method or input method. Please comment down below. I'll definitely answer it for you, or like I'll just have a look. And otherwise I'll definitely tell you at the end of the session. So cost incurred until the date is 1 million. So how do we account for this? So the important thing that we need to remember on this kind of question is that we need to first of all determine whether it is revenue recognized on at the point in time or overtime. So what are the criteria for overtime? Overtime is basically if it meets any of these criteria. So there are 3 criteria, which is the customer consumes the product simultaneously as it is being produced. So that's one criteria. The second criteria is that the entity enhances or creates an asset for a customer which they already control. Okay, so that's second criteria. The third criteria is the entity creates an asset which does not have a alternative use. In this case, it's a specialized factory as well, so it doesn't have a specialized use, right? Alternative use, because this factory is only built for this particular entity because the other entity can't use it, so it doesn't have an alternative use. So that's the meaning of alternative use. And then after that, on that same third number criteria, what is it also mentioned is that it says that there should be enforceable right to payment for the project for the cost that has already been incurred. So you need to have an enforceable right for the work that you have done on the site. So as we just did TYU 8 as well, where there was no alternative use to the asset, but our enforceable right was only till the deposit amount. I gave you an example of 500,000 and 1.2 million. So if the cost was 1.2 million and then you only have an enforceable right up to the deposit, which is 500,000, then it is not considered as a overtime revenue. It is not considered as overtime, so you can't recognize revenue overtime. Okay, in that case. So in this particular question, let's look at this. So our contract was for 2 million, and then we would receive a bonus of 0.4 million if we were to satisfy the 18-month criteria, which is like they would give us a bonus for completing the project quickly. So on variable consideration, we learned earlier that it is only recognized if it is unlikely that the reversal won't happen. So it is probable that the reversal won't happen, then only we'll recognize revenue. So in this case, the question also gives us that it is unsure if the bonus would be received. So there it is probable that it would reverse, but our criteria is it should not reverse. So because of outside factors, okay. And then the total estimated cost is 1.5 million, and then if terminated, enforceable right is for cost and markup. So this clearly makes it clear that it is overtime recognized as revenue. And then on 31st December 20x1, what happens is that it is still unsure whether the bonus would be received or not. So it is probable that the reversal might happen because the company is unsure. And then the cost incurred till date is 1 million. So how do we account for this? So this particular question is using input method, because on output method, input method is the method which is used to recognize revenue as it is as per the cost incurred by the proportion of its total cost. Okay. So if it would have been outside method, then they would have brought a survey and then they would say, okay, this much completion is done. So we recognize revenue and cost as per their percentage, as per the surveyor's percentage. Okay. So this is the input method clearly. So what we will have to do is, how much revenue should we recognize? So I'm making an SOPL out of 2 million. How much percentage have we completed? So that would be measured based upon our completion percentage. So how do we get our completion percentage? It is 1 divided by 1.5, because this is the this is measured because of input method. And how do we get the work percentage completed? It is cost incurred till date, and then the remaining expected cost to be incurred. So we are getting a percentage of 2 by 3 or 66.67%. So when we do this, 2 by 3 into 2 by 3, so why are we only writing 2 million? Because we are unlikely, it is unlikely that the bonus would be received, so there is a chances of being reversal. So it is probable that it would reverse. That's why we are not recognizing it. So 2 into 2 divided by 3 would give us 1.33. And then after that, so 2 by 3rd would be 1.5 would be 1. So 0.33 is our gross profit. Okay. So the revenue is recognized based upon the completion of, based upon the work completion percentage. So our percentage is calculated based upon the cost till date and then the expected cost to be incurred. So based upon that, so we have already finished 66.67% of the construction. So we would recognize revenue for that same proportion, and then the cost as well for the same proportion. So now let's look at contract modifications, and on that we'll talk about different separate obligations and not a separate obligations as well. So let's look at it. Okay, in case of modifications, what we need to be aware about is that the changes or modifications to a contract, what it actually does is it increases or it changes the scope and price of a contract. So either you have to supply more goods and then you will be charged more money for that, or you will be given more money for that. So that is changes in scope and price of a contract. And then there is two things that we need to consider while taking into account of contract modifications are way to determine whether it is a separate contract or not a separate contract. Okay, so when will it be a separate contract? It will be a separate contract when the scope increases because of additional goods and services that we provide. Okay, so our scope of contract increases. So if the order of, let's say, sweets was 900 and then they increased it by to 300, so let's say they make it 1200, so that's our scope increase of additional distinct goods and services. So price increases by an amount which reflects the standalone selling price of distinct goods or services. So the increase in price also reflects standalone selling price of distinct goods and services. It should reflect the standalone selling price, otherwise it isn't considered as separate contract. We have a very interesting problem about that. We'll definitely look at it. And then the second is what would constitute not as a separate contract. So termination and creation of new contract. So this would be regarded as termination. You terminate the existing contract and then you create a new contract if the goods and services are distinct from those transferred earlier. So if it is the same thing, it isn't a different contract. It is just modifications, or it is just termination and creation of a new contract. Okay, so part of original contract. So goods and services are not distinct from those transferred before. So it is a single obligation. Suppose you are required to construct a building. So suppose you are entity A and you construct a building for, let's say, entity B. And then during the process, you had a floor plan of designing it like this, but you want to make a partition now, right? So the floor plan has changed a bit. So this change in the floor plan is also a separate contract. No, why? Because it is the same goods and services that we are transferring at the earlier on. It was our same performance obligation, because our performance obligation in the earlier case was constructing a building. So we are doing the same thing, but only what is being changed is just part of same original contract, only the prices would be adjusted. Okay, so this isn't a distinct goods and services, so it falls under the second category, and then within that as well it forms as a part of an original contract. So yeah, very important thing is to remember is that separate contract, what it does is, or what contract modification does is that it changes the scope and prices of a contract, and then a separate contract is the scope changes because of additional goods and services, because the order was 900 and then the later on order was 1200. So the additional goods and services we are required to supply, so that changes the scope. Again, the price increases. Suppose the price increase was, let's say, so 200 of additional sweets at the rate 60. So if the standalone selling price of the sweets was 60 itself, then it is that price has reflected the standalone selling price of additional goods and services. Okay, it represents the price of goods and services. Whereas if that amount would be $40, then it wouldn't be considered a separate contract. It would be part of an existing contract. It would be part of a termination of existing contract and creation of a new contract. Because the remaining goods are distinct from those transferred earlier. Because the remaining goods are distinct from those transferred earlier. So the transaction price in this case would be original consideration unrecognized plus additional consideration promised from modifications. So we'll definitely look at a question and then this will be very clear for you. So part of our original contract, as I told you earlier again, goods and services are not distinct from those transferred before. So it is a single performance obligation. So if you look at this TY Salty as well, the contract has been that we would purchase, the entity would purchase 1,000 sweets for a selling price of 60 over the course of 8 months, right? So after 700 contract has been, 700 goods have been supplied, they did a contract modification. So what happened was that the additional 200 goods were required to be provided to the customer. So additional goods at the rate 57. Okay, so it's slightly less, 3 rupees less than the original contract. And then by reporting date, Salty had already supplied them with 900 goods. So let's look at it from our contract modification perspective. Like, let's see whether it is what sort of modification is it? Is it what sort of modification is it? This one, is it a separate modification, separate contract, or it is not accounted as a separate contract? So you can say it is a separate contract. Why? Because we know exactly how many goods to provide. So it is 200 distinct goods and services. And then does the price reflect standalone selling price? Yes, it does. So our two criteria are met. So it is separate contract. So how do you account for separate contract? It is just normal quantity into price. So 900 into 60, 54,000 is our revenue then that we have to recognize at the end of the period. And then the further on, like for 100, next 100 will be recognized as per 60, and then 200 will be recognized as per 57. So in case of B, the question has given us an assumption that the normal standalone selling price is 57, but when the new contract happened, so when they signed a new contract, they signed it at a lower price of 40. Okay, so that price does not reflect standalone selling price. So now you might be thinking whether is it a separate contract or not a separate contract, because it hasn't met the second criteria. And then after that, after supplying 700 of the goods, 700 quantity of sweets, the company canceled and created a new contract. So why am I saying is it a new contract? Because it is supplying additional 200 goods and services. That's why. But the price does not reflect. It does not reflect the standalone selling price. Okay, so it is not counted for as a separate contract. It is regarded as a cancellation of existing contract and creation of a new contract. So in that case, there were two things that we had to consider was we had to add up unrecognized consideration from original contract and additional consideration purchased. Okay, so we have to determine the new transaction price. So the 700 into 60, this is already been recognized. So what about the additional goods and services? What would be the transaction price of that? Because we are getting 60 for the rest of them. We are only getting 60 for 300 and 200 for 40. So let's see the wordings as well. Unrecognized consideration from original contract. So the unrecognized is 300 is still left to be supplied, right? Into 60, 18,000, and then additional consideration promised is 200 into 40, because that particular entity is only giving us 8,000, and then our revenue that would be recognized at the end of the period is 42,000 plus 200 into 18,000 plus 8,000 divided by 500. So what I did was I added these two things up, and then I added the quantity, this quantity and this quantity down below. So I'm just taking the average figure. So this would give us 52 average into 200 plus 42. So the trick is that you need to remember where to apply, where to regard it as a separate contract, or it isn't a separate contract. So based upon that, we will have to look at the price, and then whether it reflects the additional, whether it reflects the on a normal standalone selling price or not. Otherwise, if it does not represent normal standalone selling price, then it could be cancellation of existing contract and creation of a new contract, or it could be the other one, which is part of a same contract. Just the difference is just the floor plan, as I've given you examples earlier on. So now let's look at construction cost. Construction cost. So in this construction cost, the important thing that we need to remember is contract cost. Contract cost. So it talks about what kind of expenses that we can capitalize. So what kind of expenses can be capitalized? Capitalization for those costs that are expected to be recovered. Expected to be recovered. And then those that don't fall under the scope of IAS 2. Okay, so what are expenses that are expected to be recovered? Are those expenses which are specific to a contract, such as winning the contract. Winning the contract. So, such as professional fees, and then surveying fees are not capitalized because they are a usual part of your operation. You would have to do it, even though if you don't win the contract as well, you are required to do it. So the bidding fees are always required to be paid, right? The deposit amounts, the purchasing price of the bidding documents are always required to be paid, even though if you don't win the contract. Whereas a staff specific, suppose you're giving a staff 5,000 for this particular contract, for winning this particular contract, then it is expected that this 5,000 would be recovered, so it is capitalized. So professional fees, normal course of the as we used to do, like transaction costs are not recognized because it is a market characteristics. It is same as that, and then only the special price which can be attributed to winning the contract is capitalized, okay, and then IAS2, which does not fall under the scope of IAS2. The important thing that we need to remember is when presenting, how do we present this as per IFRS 15? So what IFRS 15 says is that you need to present it as a receivable when you have a right which is unconditional. So what is unconditional? Unconditional is it is a right which is only for passage of time is required for it to be recognized. So that is unconditional. Okay. So the condition being that only passage of time is required, whereas in case of contract assets is you must do something else other than passage of time. So during when you actually have satisfied your performance obligation, and then only the passage of time is required, then what you will do is you recognize a receivable. Whereas in case of contract assets, what you do is if you are required to do additional something else other than passage of time, then it is considered as contract assets. So what about contract liability? Contract liability is when we normally do this is when you actually receive the cash. So debit cash, credit revenue, credit contract liability. So this could be 2, this could be 1, because you have already, suppose this was for a transfer of goods or services, you have already transferred it, so you can recognize revenue for it. But if you were to service it at a later date, then that is a liability. So what you would actually recognize it as is contract liability in your balance sheet. So these are the 3 things that we need to be careful about, and then if we show them as a contract assets as per their definition, and then what is contract liability. So if we categorize them based upon these, it will give a more fair and true picture. And then the other thing that we need to remember is unconditional. What is unconditional? Unconditional is when does it become unconditional? When only the passage of time is required for the payment to be received. Okay. So what about disclosures? So what sort of disclosures are we required to make? So the disclosures that we are required to make are revenue that we recognize, normally just comes in our revenue at the SOPL as well, and then contract balances and assets recognized from cost incurred obtaining or fulfilling contracts. Same as this categorization, whether it is receivable or contract assets or contract liability. So categorization as well, and then we also need to write down this in our disclosures, significant judgments used, and if there has been any changes in our judgment. So what is judgment? So you could say, like, what sort of judgment did you use in this IFRS? So we used the probable benefits that being paid. So it's a probability, and that's also a judgment. We don't know quite sure, so that's a judgment, right? So that judgment we have used, so we have to disclose it. And then variable consideration. So in case of variable consideration, it is probable that it won't reverse, right? So that's the case. So we are not quite sure. That's also a judgment, right? So it could reverse in the future. So you have to actually let the users of financial statements know about it. So we need to make a disclosure about that as well. And then if you're a construction company and then you use like input methods, so that is also that needs to be disclosed, because otherwise sometimes output methods could be better for like presenting it to a certain type of users and then for certain type of other users. So that's also judgment, right? So you are making a judgment which actually gives the true and fair picture. So it's all these judgments needs to be disclosed in the financial statements. Okay, so so far all good, I guess. And if you've got any other comments, questions, whatever, please do comment down below and we will answer it for you. Until next time, bye bye.